The first one I want to go through is just what is decision fatigue? And decision fatigue refers to any state, mental exhaustion that occurs from making too many decisions resulting in reduced cognitive function. Meaning the more you do something, the more eroded it's going to get. The more we do it over and over and over again, the more eroded it's going to get. It's just the way that it is. You're going to get better and better, but you're going to get away from what the true sense of that trade was supposed to be. And it's just the way it is. You'll get lazy. You'll start going outside of your parameters because you think it's okay. You'll start taking more risk on trades that you know don't fit those criteria. And that's all based upon decision fatigue. Decision fatigue can be reduced. And I'm going to explain how to reduce decision fatigue so that you can make better decisions and that you can make more decisions, but you can make them better. And we'll get to it. The other thing that I want to refer to today, and I'm going to use it differently, I believe, but in the same vein, I think it's supposed to be meant. First principles thinking is a problem-solving method, breaking down complex issues into the most fundamental components, questioning everything, and then building back. So what you need to do here, and the way that I always look at first principles thinking is, think of everything that you're doing as not working, and then go back and say, where are you trying to get to? So first principles thinking for me, I tie it into like reverse engineering. So in other words, why are you doing what you're doing? And by that, I mean, like, why are we trading? Why are we doing the trading? What is the purpose of the trading? Is there a reason for it? Why are we doing this? And I think that's really important. So you're doing this for one reason. You have a goal in mind, and the goal is to make money. There's no other reason to trade but to make money. So the first principle thinking is, all right, how do I get from here to my goal? And what I do is I just say, well, the goal is to make money. There's no other goal for doing this. There's no other goal in trading than to make money. There's no, let's just call it what it is. There's no social value added to trading. It's just trading. What you do with the money can have a social impact, but trading or investing has one goal: to make money. It's to not lose money. So everything that you do and every decision that you make has to lead to this. If it's not leading to this, why are you doing it? And so by looking at this with the scope of decision fatigue and looking at this from the decision of first principle thinking, well, that means that I want to buy stocks that are low that go higher, and I want to sell stocks that are higher that are going to go lower. And I want to profit from that, and that's going to lead to this. And then you go, okay, great. That's what I'm trying to do. I'm trying to get into the green box. I'm trying to make money, and I want to boil down everything that I'm doing. So what I tend to do is just start with the basics. Now, we can use the S&P or we can use any stock that we want. It doesn't matter. But what I tend to do is get rid of everything. So I would get rid of candlesticks. I would get rid of green and red. I would get rid of every single thing on my chart that is just not telling me where the open, the high, and the low, and the close are. So all I'm looking at is price. I'm not looking at volume. We haven't decided anything yet. Do candlesticks matter? Does volume matter? Does any of this matter yet? We're not even there yet. We're not even thinking like that. All we're doing is going, I'm getting decision fatigue because I'm making too many decisions. The goal is to get into the green box. And to do that, I have to buy something low and sell it higher. I have to buy something high and sell it higher. I need the price to appreciate if I'm long, and I need the price to go down if I'm short. That's all you're doing in these scenarios. So, okay, well, how do I do that? Well, the first thing is you implement what you know already. And then you say, okay, is there value in this? And will that help me to get into the goal of the green box, which is to make money? So if we look at something like a S&P, we'll just take Friday. And what we're going to do is we're going to go on one basic premise. We'll go on the premise that the recent talk about HPIs and LPIs was of value. And we'll go on the premise that when I stop taking out lows, that I'm probably not going lower. And when I start taking out a higher high, I'm probably going higher. We're going to just go on that premise. So we would look at this and say to ourselves, okay, well, when we look at this peak right here, and that green arrow pointing down is telling us that this would be an HPI or a high point of interest. And then we're looking at this and saying, okay, well, these bars encapsulating here and over here would be what we refer to as a low point of interest. All right. And so once we have that, and we also have this being a low point of interest here. And then we say, okay, well, that is appealing. And if you haven't watched that video yet, you can. But essentially what we're doing is just saying what bars are of interest and which ones are not, or what patterns are of interest, rather. Not candlesticks, not green, red, none of that. Not volume. We're just looking at this. Then we go over here and look at this and go, okay, well, that was a low point of interest down, under, flips, closes above it. And that was a low point of interest that really got us nowhere. And then we undercut. Okay. And so you have this high point of interest over here. And what we're doing, if you can see, we're just going to take it back to roughly that 9. There we go. Give me that 9:30 time. And perfect. So you can see from here, that's 9:30 over. And we're just marking off to start just these places of interest. Well, over, under, well, that's a low point of interest for sure. And then again, we're just going through them and seeing where they are. And we're just allowing them to play themselves out over and over. But we don't know that we're here yet, right? So when we're watching during the day and all we have is price and we don't look at anything else because we don't know yet that anything else works. All we know is that we have price. So when we're watching the day play out, all we know right now is that we have this. And we know that this is an area of interest. And then what we do is we would mark off that area of interest with a green arrow. Or what we might want to do is just drop a line at the high of that entire area. So what we might want to do is drop a line at the high of that entire area. Not on the candlestick, not on the body of the candlestick, not on the, just at whatever the high is on an open, high, low, close. Right there, we're just going to drop a line on it and go, okay, what's that telling me? Well, it's telling me we had sellers here and that's the highest HPI that we have. And maybe we'd look back at time and see if there was anything of consequence there. We had another HPI around here or not. Maybe there is something, maybe there isn't. Different time to talk about that later to even suggest if we should be going back and looking at time. Right now, we're just saying we don't even know if that makes any sense to even look at the past. Then what we would do is just allow this to play out a little bit. And while it does that, we're taking these events and we're marking them off as levels of interest as they play out. And all we're doing is not saying they even matter. We're just marking them off right now. And then as we're doing that, allowing them to play off, you might go, okay, well, that was a level of interest that we marked off. Then we got to this level of interest, which tied to that level of interest. So we had the LPI over here. You have an HPI over here that hit LPI, HPI, LPI over. Oh, okay, well, that's interesting. So we got over that level, which we rejected there. And then what we might want to do is say, whoever was selling in here, they might be tired of selling because now we're over that level. And so that this may become a bar of interest. And that might be an area where we might want to buy because now we have up, down, up, right? We have this there. And so we can see what we would refer to as a change in trend. And then we might even have people that would draw things like this on it and go, oh, well, that makes sense because here's the DTL. But in regards to first principle thinking, we don't even know if DTLs matter yet. We don't even know if that's a thing. Maybe they're garbage. Maybe they don't matter. All we know right now is that this is working at determining getting over an HPI that worked. And then you have this LPI here. And then you just allow this to continue to play itself out. And you start watching these levels. Now, when you get to these levels, what you're doing is the same exact thing. You're just marking them off. If you think this is too rudimentary, you're wrong. Because what you want is a base. And once you have a base, you go from there. Then you add things. We'll get to that. So then you mark this off and you go, okay, that's my day. Now, if I'm to look at this day and to say, is there any value in this whatsoever? Did this tell me anything? Well, someone would look at this as a data point and saying, okay, when you have the HPI as a resistance point, which they are, and we can see that very clearly, resistance point, resistance, get to another one, resistance, stays resistance. So we have a resistance point and we start getting over that HPI, that becomes a place of interest where I really want to be involved. I want to be involved right here. Why? Because we know that HPIs are resistance points because we have a return or reversal of trend. You don't get, we know this, these are facts. You're not going to get an HPI or an LPI unless you have a reversal of whatever trend was going on. So if I'm here and I'm dropping, I know that this drop was precipitated by this pattern up here. I know that when we popped up, it was precipitated by this. It doesn't mean that this pattern might not continue, but we know it was halted by this. So this becomes a place of inflection. Inflection, up, and then on and on we go. So what this is doing for us, if we are to look at the very basics of this, we would come up and decide that and we used a 5-minute chart here, on a 5-minute chart, if I get two LPIs around the same level at the bottom, and then I flip an HPI, I probably want to go long, whatever it is, and I want to use this. So what you've done there is you've created a little idea in your head that might work or it might not work. And what you're saying is this became a real issue point, the up, down, up. And then when we flipped, we never looked back. And from there, we never had to worry about running into anything. They actually gave us another area to use as a stop for reversal and trend. And then they gave us another one, and we never really had to worry about it. All right. By using just the idea of first principle thinking, or by using the idea of decision fatigue, you would just map out and go, all I need to have happen is for this to overlay itself. And then once it overlays itself and goes over, I'm a buyer. And then what you would do is you could go back through it and test it over time and go, oh, this is all I do. And go, really? And then you look at whatever that data set is and say, okay, this is what I do. Now, if you have that on your chart and you don't have anything else on your chart, think how much easier it is to make that decision versus, and I'll give you something that is like super over the top. So if I look at something like this and go, okay, well, this is going to tell me that I need to buy here, and then I need to do this, and then that's my stop. Or you're looking at this. What's easier to make a decision about? Right. So the easier decision is obviously looking at this. Anyone's going to see that. If I put this chart up versus this chart up, and you're not familiar with this, or you don't even know what's really happening here between the clouds, the parabolics, the directional movements, negative, positive, overall, the channel of the commodity or the channel of the asset versus that, like what's easier? Well, this is a no-brainer. And what your goal in adding all these things is doing is this making my decision-making process easier or harder? Is this decision-making process making my win rate go up? And am I making more money? If it's not doing those two things, even if it's doing one of them, you don't want it.